Good afternoon, everyone. It's Fed Day. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and we're here to take in the decision as it hits. I'm here today joined by David Wilcox. He is Director of U.S. Economic Research at Bloomberg Economics. From 2011 to 2018, David was Director of the Federal Reserve Board's Division of Research and Statistics and also served as a senior advisor to 3 Fed chairs. So he has very much been in the room, and he's going to give us some guidance on what it's like to be there on a day like today. Also here with us, my usual sidekick, Allison Schrager, Bloomberg Opinion columnist, a senior fellow at the Manhattan Institute, and author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. So like I say, Fed Day today, we're expecting the decision in just about 5 minutes. The expectation broadly is that policymakers will hold the rate steady at a range of 4.25 to 4.5%. But the real action here will probably be in the Fed's summary of economic projections, as well as the Jerome Powell press conference. Just for reference, the last dot plot contained in that summary of economic projections suggested that we'd get 2 rate cuts in 2025. So we'll be looking perhaps first and foremost to see if that's tweaked and what economic projections sort of are behind that expectation, any change in that expectation. But let me turn it to you now, David. What matters here on a day like today?
I think most of the interest, at least for me, will center on Jay Powell's press conference. I don't think the statement is likely to be very revealing, but Powell's going to face some tough, challenging questions. For example, how much have committee members taken on board from Trump administration communications about tariffs and other economic policies? What does he make of the president's move to fire 2 FTC commissioners yesterday? That might seem like it's detached from the Federal Reserve, but it's very much not detached, because the employment security that FTC commissioners relies on exactly the same legal foundation as the employment security of Federal Reserve Board governors. And so if the courts rule that Trump can indeed remove FTC commissioners, then that really spells, I think, the doom of Fed independence. And as an institutionalist and great fan of the Fed and believer in the importance of the independence of monetary policy, I think that would be a big step in the wrong direction. I think the last topic I would point to is the question of whether inflation expectations are becoming unanchored. There's some troubling evidence that we can discuss as the conversation goes along that maybe something with the inflation anchor is slipping in a way that we didn't see through the COVID surge period.
Yeah, well, a lot to think about there. And I know we're not going to be able to get into some back and forth on that in the minute before we get the decision, but I absolutely want to come back to each one of those items. Allison, same question to you. What matters to you on a day like today, where, as David sort of underscores, there are all these questions around the policies coming out of this White House? Policymakers, economists, if they're being honest with us, there's just so much that they don't know and they can't incorporate into their models here. So what really matters?
Well, I'm curious just to see their projections. I mean, right now they're still anticipating rate cuts later this year. And as David pointed out, with unmoored expectations and the possibility and sort of inflation that doesn't seem to be going anywhere right now, at least, and an outlook for even higher inflation, a lot of these projections are just starting to feel like a bit of a, fantasy.
All right. Well, fantasy or not, I think everyone would agree there's just so much uncertainty around these numbers, and any number of policies could could swing them fairly dramatically, I think, in several directions. We're going to get some actual concrete figures to sink our teeth into in just about 5 seconds, though, and I will take you to them as they hit. So there you go. As expected, policy rates unchanged at 4.25 to 4.5%. I want to underscore that we see no change in the median rate forecast for this year, still expecting 2 cuts. If you go out to next year, again, no change. And then this is actually, let me let me revise that. I misspoke. So the expectation here is that the FOMC median moves to 3.875% for this year, and that is down. You also see. But it meets expectations with the Bloomberg survey. You also see it coming down for next year, but again, meeting expectations in the Bloomberg survey. And finally, stepping down at the 2-year horizon, but meeting expectations with the Bloomberg survey. And one final thing to point out, no change in the FOMC's median rate forecast for the long run. That's sort of representative of where we look at the long run neutral rate. So David, coming back to you, what do you make with these with this series of forecasts that we're seeing here?
All things considered, given the incredible uncertainty in the environment, I would say there's remarkably little change here. As you summarized, John, no change in the funds rate projection. Core PCE inflation this year has been marked up 0.3 of a percentage point to 2.8% over the 4 quarters ending in the fourth quarter of this year. The unemployment rate has been marked up 0.1 of a percentage point to 4.4%, and a small downgrade as expected in the GDP projection. These forecasts, I think, are pretty squarely in line with the consensus expectation and with Bloomberg economics forecasts.
Sure. Let me take you all to just a few headlines that are crossing over at the Bloomberg News blog here. So the unemployment rate forecast nudged up slightly to 4.4% this year from 4.3% in December. For inflation, policymakers now see both headline and core prices advancing at a faster clip than they did previously. Off of the back of this, you do see the S&P 500 moving up a little bit, but it's not a dramatic move, sort of on par with some of the wild swings that we've seen in recent days. On balance, the market taking this fairly well. Allison, you were sort of making the point earlier that you didn't think, you thought it was hard to see the case potentially for any rate cuts here, but this committee is still expecting rate cuts, very much so. What do you make of that?
Well, what else are they going to say? Like, if they're saying we're not going to cut rates, they're saying, guess what? I guess we can't reach the target. And they're never going to admit that. It's sort of like, well, inflation, we couldn't make, for years, we couldn't make the target because inflation was too low and now it's too high. And I guess there's nothing we can do about it. So we're just going to sit there. So, I mean, they're trying to play an expectations game, which is being like, yes, inflation is still going down and we're going to cut rates as that happens. So, I mean, I would expect them to say it, but I don't expect them to actually believe it.
Yeah. And let me also just give you a sense of what's going on over at the statement. So the key changes here in the statement, first series of changes happen in the second paragraph. We see the statement now reads, the committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. And then it says uncertainty around the economic outlook has increased. The committee is attentive to the risks to both sides of its dual mandate. That's a bit different. This section of the statement had previously read, the committee judges that the risks to achieving its employment and inflation goals are roughly in balance, right? So we are now underscoring high and prominently this idea that uncertainty around the economic outlook has increased. I'll also take you down to some new language in the third paragraph. It now says, beginning in April, the committee will slow the pace of decline of its securities holdings by reducing the monthly redemption cap on Treasury securities from 25 billion to just 5 billion. Sorry, to 5 billion. The just was my own language. The committee will maintain the monthly redemption cap on agency debt and agency mortgage-backed securities at 35 billion. David Wilcox, what should we read into this tweak to the QT policy?
I think that's pretty much as expected. Really, the change in the statement that jumps out at me, John, is the underscoring of uncertainty. This is, I think, a delicate way of the FOMC saying, we're operating in a very difficult environment. We understand that consumers are operating in a difficult environment, that business decision makers are operating in a difficult environment with the incredible amount of uncertainty that's been injected. You see this, by the way, not just anecdotally. You do see it for sure anecdotally in survey results like the University of Michigan, but you also see it quantitatively in various indexes of policy uncertainty, several of which have spiked to astonishing levels in the past few months.
Yeah. Well, let's take this conversation back to sort of where we started here, David. So we have a committee expecting rate cuts this year, but also at the same time projecting an increase in uncertainty. And at the same time, we have this series of data points from the University of Michigan and, if you like, a certain cut of the Federal Reserve Bank of New York's inflation expectations, showing that inflation expectations are maybe rising. I don't know if you'd say becoming unmoored, but certainly rising. Is this a mix of information that makes sense to you?
John, I'm going to pull an audible here. I've been multitasking, but I don't know whether you mentioned that Chris Waller dissented, and he dissented.
Excellent point on the QT issue, right?
He did, but he dissented. He said the statement says he supported no change in the federal funds target range, and so he wanted a different mix of policy.
Right.
So you're right. He was in line with the committee decision for the funds rate target, but he wanted to run down the continue running down the securities portfolio at a faster pace. I think we'll need to hear some more from Governor Waller in coming days about exactly his rationale, but maybe he is concerned about what Allison was pointing to, which is the troubling emergence here of a little higher inflation than had been earlier projected by the members of the committee.
And I
Okay.
think also the uncertainty is super important because if you think about what's in the term premium, which also speaks to QT, it's not just inflation expectations, it's risk around inflation that
Right.
really sort of can drive up term premiums. So even if expectations were not elevated for inflation, and honestly, there's been more variability since inflation returned around what inflation is, which is one reason why they never really looked as sort of anchored as I think a lot of people thought. So I think my feeling about inflation is everyone sort of was very confident in low inflation for a long time, but once it came back, people sort of expectations just become a lot more fragile. Any sort of whiff of, inflation might be coming back, they can become unmoored very quickly. And that sort of is going to speak right into the term premium, which I think maybe explains sort of this sort of change around QT.
I think that fragility point you make, Allison, is really key. The environment that the committee faces today is qualitatively different than the environment they faced 2 years ago. 2 years ago, households and businesses were operating on a conviction born of 4 decades of experience that inflation would be low and stable, that the Fed would get it back to 2%. Now they've been, to some extent, maybe disabused of that firm conviction. And so I think they're operating on much more fragile, treacherous terrain today than they were 2 years ago when inflation was raging.
Yeah, this is not an easy job because not only are they might have to make some unpopular decisions, but as David pointed out, their independence is also not as assured.
Yeah, let me try and push back a little bit on this notion that inflation expectations are becoming a problem here. I wouldn't argue that inflation expectations are not becoming a problem here, but isn't it the case that we're basing this conclusion to a large degree on surveys of consumers and households, and that these surveys are very, very difficult to conduct? There are a couple of problems here, I think, that many economists are well aware of. I think number one is the fact that economic literacy is not great across the United States. And you see this if you look at like microdata from the University of Michigan survey. People will give totally bananas answers to the inflation question. They'll say, I'm expecting like 50% inflation or something like that. I'm just pulling a number out of the air, but there are literally answers that are close to that. And secondly, another thing that gives me pause, University of Michigan, I think, does us the favor of breaking down its survey along party lines. And so we see what Republicans think and we see what Democrats think. And I take no position on who's right and who's wrong, but it's like these two groups are living in completely different worlds. And so I wonder if, given those two facts, we should place a big old asterisk next to any conclusions that we make from survey-based inflation expectations.
Well, so you're an informed person, for sure.
I'm a what person?
An informed person. Are you confident inflation
I try.
is going to be 2% in the next year and a half?
I would say no. I would say no.
I'm not.
But isn't the broader question whether or not I am taking sort of like any self-fulfilling actions around those deeply held beliefs? I don't know that I really am. Like I'm not panicking that inflation is going to be 5%, and I don't think that I massively change my behavior because I think inflation is going to be, around 3% instead of the 2% that the Fed told us it was supposed to be for the longest time.
John, you're not wrong that economic measurement is really challenging. You're not wrong that surveys of household opinion are very difficult and subject to lots of head fakes. Yeah. What has me on high alert is that what we've seen over the past 3 or 4 months from the University of Michigan is not just one reading that's
Mhm.
unnerving, but
Right.
a string of readings, all of which are moving in the wrong direction as far as the Fed is concerned. And then to compound my unnervedness, to make up a word here, this is a live to stream broadcast, so editors can't step in and correct my grammar. What compounds my unnervedness, in addition to that trend, is we never saw anything like this move in the longer term inflation expectations from series from Michigan. We didn't see it during the COVID inflation surge. We're seeing something different today. And I think that compels us at a minimum to ask some hard questions. What is going on? What's different today than was different in 21 as inflation was ramping up, in 22 and 23 as inflation was way too high? Conviction among University of Michigan survey respondents remained strong, remained rock solid, that inflation would come back to something consistent with 2% in the longer term. And that doesn't seem to be showing right now.
Sure. Okay. Just
Okay.
to review. Sorry, go ahead, Allison.
I just also think
Finish your
the
thought.
noise is also important. Like there wasn't as much noise pre-pandemic because everyone felt confident. So I think even the sort of the second moment here is meaningful.
Yeah. All right.
Yeah, I think that's an important point, Allison. If you look at measures of dispersion, Jonathan mentioned, yes, there are people who, even in placid times, will answer they expect 50% inflation. Right now, those measures of dispersion have blown out by a lot. So people are just reacting to this environment by giving all kinds of answers in a much more broad spectrum way than had typically been the case. Allison, take it away. I think we lost Jonathan.
I know. I feel bad. He had like a good question too. Oh, is he coming back? Here we are.
There we are.
I'm back.
Thank goodness.
Can you hear me?
Yep.
Yep.
I interrupted you. I'm sorry. What was your question?
I am not exactly sure. still trying to figure out what went on with the technology. In the meantime, I did want to ask you, Allison, about the FOMC median of the longer run projections for the Fed funds. Are we all back here?
Mm-hmm.
The gang's all back. All right.
Yeah, I think 1% real is a little optimistic. I think there's a lot of reason to expect like a high R-star. I mean, no one knows for sure, but effectively they're like, we're going back. I feel like their projections have been saying for years, we're going back to 2019, just maybe a couple, like 20 or so basis points higher than it used to be. And I understand why they want to put that out there. But again, I mean, I'm curious if David thinks like the fact they keep putting out these projections or what they would like to be true, but is blatantly not true, ultimately is going to undermine their credibility in the end.
Well, I guess I'd push back against the phrase blatantly not true.
Optimistic, aggressively optimistic.
So I think the incentives for the committee are to do the best that they can. But I've been in the economic forecasting business for 35 years, and I'm fond of repeating the old aphorism about how economic forecasting was invented to make weather forecasting look good. I've been wrong. I was wrong about the COVID inflation surge. That was after I left the Federal Reserve, but I took a hard look at those data, and I thought the FOMC's summary of economic projections at the time looked completely sensible to me. And by the way, so did the consensus of Bloomberg forecasters. I wrote about this in early 2022, and the FOMC SEP median was squarely in line with the Bloomberg forecast, and those those are the people who are on the front lines of capital markets, have every incentive to squeeze the last basis point out of their inflation forecast. And so, I think the SEP has to be taken at face value as representing their best guess in a treacherous, messy business. If you don't want to get splattered by mud, don't get into the economic forecasting business.
Well, let me also push back on this notion that neutral has to necessarily be much higher than the mainstream thinks and the SEP indicates at the moment. I mean, for the longest time, the core of that argument was like, look how tight we are right now, and look how strong real GDP is. I don't think that you can necessarily make the same argument here in the first quarter of 2025. Now, you might say that, well, the reason parts of the economy are flashing warning signs are because of policy, and if you hadn't put this policy in place, then maybe things would have continued apace, at well north of 2% real growth. But I don't know. I mean, parts of this economy are clearly struggling. Certainly the rate sensitive parts of this economy are clearly starting to struggle here. I think that's definitely true of housing. So I don't know. Given that, Allison, is this a great time to be leaning into, well, neutral must be higher?
I mean, this is why I just feel like maybe they're showing a little bit too much. Like, I'm starting to sort of feel like maybe they shouldn't put everything they're thinking out there, because I honestly don't know where R-star is going. The macroeconomist in me feels like we're undergoing a structural change of just higher interest rates. We have more uncertainty around inflation. We've got demographics. We've got Europe issuing more risk-free debt too. So the market is just going to be different. So, I mean, that's just my own personal macro view. But honestly, I don't know. None of us do. So it's sort of like, why put something out there that is just completely unknowable?
All right.
John, can I just
of course.
offer, if you look back in the basement of the SEP forecast document, what you see is there's a big move toward higher uncertainty around the GDP growth estimate. There's a substantial move to ranking risks to GDP growth as being weighted to the downside. And there are parallel changes in the assessment of uncertainty for the unemployment rate, and likewise, risks to the inflation forecast have been marked up with greater uncertainty around the inflation forecast. So I think Allison's point is spot on, that there is a tremendous amount of uncertainty. She's spot on that the one thing we know for sure is these projections will not turn out to be accurate. Where I think I part company with Allison is, I think it's still useful for investors, business decision makers, and others to know what the Fed's best judgment is, fallible though it may be. These are all guesses. They're not more than that, but they're the best informed guesses. They're as good as anybody else's. And so I think it's important from the point of view of central bank transparency and accountability that they put this information out in the public domain.
Sure. And to your point, there were a lot of things that that weren't spot on, even if you just go back to what happened in 2022, 2023. But those measures of uncertainty were transparently also spiking at that time in this summary of economic projections. So at the very least, policymakers are telling us sort of transparently what they don't know.
It'd be really interesting if someone did a paper. I think Arpit Gupta was showing me that one of his students were looking at how the 10-year responded to rate decisions, and he actually found a relationship. Is to see if that has changed after the sort of inflation came back and these projections seem to be a lot less sort of consistent with what accurate. I would be, so that way we can get a sense of sort of what people's sort of longer term markets for long term rate projections are doing. So if anyone does research out there, I'd love to see that.
All right. You want to share your email for a collab there, Allison?
I'm out of that game, but I think there's a lot of big data and skills I don't have there, but I would like to read the paper.
All right, fair enough. Hey, we've got about 5 minutes until we end here and let you go over to Jerome Powell's press conference. But I do want to touch on a couple of things. I want to sort of preview that press conference. David, as you underscored in your opening remarks, there are a lot of delicate political questions here that Chair Jerome Powell is working with. He was sort of attacked in plain daylight during the first Trump administration. The administration has not been friendly to him, at least, in the public discourse, in public messaging on social media and so forth recently. And as you underscored, Trump has just fired both Democrats on the FTC. Obviously, grave risk to Fed independence here. How would you have recommended that Jerome Powell deal with this? What should be his message? How should he tread carefully in this press conference here, knowing the political sensitivities out there?
Unfortunately, I've got not the answer you're probably looking for. I think he's done superbly. I think what he's done is kept his head down. He's been unbelievably disciplined. He said, we're going to stick to our knitting. I'm not going to die on every hill. I don't think he used that phrase, but that was the concept. I'm going to be very clear about what our core values are. Our core values center on the absolute importance of the FOMC being able to set the stance of monetary policy without being second guessed by elected officials who have shorter term horizons. Yes, the Fed is accountable. No question about that. It's accountable first and foremost to the Congress. The chair goes and testifies twice a year. There are many testimony appearances. Yes, there should be extensive communication between the Fed and the executive branch, no question about it. But Congress delegated to the Fed the monetary policy decision for a reason. And that reason is that the economic literature is strikingly clear about the economic performance benefits over the long term of delegating the monetary policy decision to an independent central bank. So I think his job this afternoon and in coming appearances is to maintain that message discipline, keep his head down, don't pick fights that he doesn't need to pick. And he's been, to my ear, he's been superbly successful in accomplishing exactly that thus far through very treacherous terrain.
Okay, Allison Schrager, what would you like to hear from the chair that we haven't learned already from these tweaks to the statement language, these updates to the summary of economic projections? What do we still need to know that could be useful?
I mean, I'm curious his thinking around QT, but mostly, this is going to be it's a hard road to walk right now. So I don't anticipate getting a lot of information, but honestly, I'd consider that a victory because I think just getting through this press conference with all the pressure he's under, both, in terms of the independence of the Fed politically and all the uncertainty he's facing, as I said, maybe some stuff on QT, maybe some stuff on long-term R-star, but really just, sticking to the script, I think will be a great victory. Yeah.
David, having been in the room, as Chair Powell goes into this, does he have sort of lines prepared for when he inevitably gets these questions about President Trump? In the past, we've heard him say things along the lines of, "I won't be making any comments on policy that is not yet in the macroeconomic data, paraphrasing here. Are there a series of talking points that he's just going to very narrowly stick to that he would have prepped with his team beforehand?
I guess I'd put it this way. He knows exactly what he wants his message to be. He will have rehearsed that very assiduously. You don't leave something like this up to chance. It would be foolhardy in the extreme to leave this up to chance.
Whoops. Are you still with us there, David?
We almost made it to the end too.
We almost made it to the end. All right. Well, I'm gonna wrap it right here and let everybody go over to Chair Powell's press conference. The decision today was to hold in a range of 4.25% to 4.5%. The dot plot of rate projections is showing the median official expected lower rates by half percentage point. The key to all of this is really in the projections and what we're about to hear from Chair Powell. So we'll let you get over to that right now. Thank you very much.